Hello and welcome to Dukascopy TV. And so soon after the temporary agreement in Washington to end 16 days of a partial government shutdown, our focus turns to the emerging markets and in particular India and the rupee. The main reason? US dollar liquidity. For now at least, emerging markets can breathe a sigh of relief and will continue to grow as long as the US dollar maintains its status as the world's reserve currency. Recently, however, India's central bank has been dealing with aggressive inflation that could force the bank to increase borrowing costs. As a result, the rupee is falling. Well, joining me on the line is Manuel Schuster, a senior analyst at Raiffeisen Bank. Manuel, thanks for joining me today. First off, do you agree that inflation is having a big effect on the rupee, given that we've seen a drop over the last few days? And what will be the next step for the country's central bank as far as tackling this inflation?
Inflation has been picking up in August and also in September. We are now at 6.5%. And this level is clearly much too high for the central bank. And if you look at the consumer price inflation, which has been below 10% or close to 10% over the last few months, it is, of course, a key issue for the new central bank governor Rajan to fight inflation from a monetary policy viewpoint. On the other hand, inflation is also and has been a structural issue for the Indian economy. You must think of all the supply side constraints, of inefficiencies, of loss of productivity, and this whole mixture brought also the Indian rupee under pressure and will keep pressure high on the currency. However, as long as the foreign environment remains favorable, especially concerning US dollar monetary policy, the Indian rupee, I think, will remain close or slightly below 62 or 61 to the US dollar.
Some analysts believe the central bank will boost the price of lending soon to accommodate such inflation. Do you agree, and is this likely to happen soon?
Yes, I think this is very, very likely, especially with the recent pick-up or acceleration in inflation, both in the wholesale price inflation index, also in the consumer price inflation index. And I would expect the central bank to hike the key interest rate by 25 basis points to 7.75%, and perhaps it might even go further at the next policy meeting, because it is important for India to keep a high interest rate differential, especially in comparison to the United States, to attract huge capital inflows. This is the key interest on the one hand, to stabilize the external sector, and on the other hand, to slow domestic credit growth, to keep inflation or inflationary pressures in check.
The RBI could be looking at ending an emergency facility aimed at the exchange rate between the US dollar and the rupee. Could the removal of any measure, or tapering of it if you like, seriously harm the currency right now?
I don't think so seriously. We have seen a very, very well-doing stabilization of the Indian rupee, and the global environment is much calmer at the moment as well. So global investor sentiment is quite high, and I think with the prospective prolongment of the US dollar monetary policy easing and the postponement of the tapering, investors are still keen on emerging market debt, on emerging market equity. So inflows should remain high and support currencies like the Indian rupee. Although over the medium term there might arise renewed currency pressure when outflows might re-accelerate again. But this is a risk for me, I would see, rather for the first half of 2014, but not immediately.
Just finally, before you go, Manuel, on a slightly separate note, there's talk of India possibly dipping into its forex reserves to bolster its current account deficit. Just how realistic is this comment from the World Bank likely to hold true?
Well, India already used a small part of its foreign exchange reserves, and reserves have come down a little bit from a peak of, let's say, $270 billion towards slightly below 250 billion. But I would line out two things here. On the one hand, Indian foreign exchange reserves are really high. They are at a very high level. And on the other hand, the trade balance has been improving gradually over the last few months, owing to some measures concerning the size of gold imports, but also thanks to a pick-up in foreign demand and a little bit more favorable commodity price environment. And I would expect this development, let's say, to continue in the next months. So I think the current account deficit will improve gradually, also thanks to very low domestic demand pressures. So there might be a point that when especially global investor sentiment darkens again, that the central bank might have to use some of its reserves to stabilize the exchange rate. But I would not see this as very likely at the current moment.
Well, more to come later on today here on Dukascopy TV, including interviews on Eurozone rebalancing and an inside look into unemployment in Asia. But that's it for now from me. Bye-bye.